Well, even though this was a holiday shortened week, that didn't stop the mortgage market from quietly pulling off a win. After three straight days above 7%, the first time that's happened since February, the 30-year fixed rate finally broke its mini streak. And by Friday, it had settled at 6.95%, which is down 0.12% from the week prior. Jumbo loans even eased to 7.06%. 15-year fix dropped to 6.21, and government-backed loans like FHA and VA also softened slightly to 6.45 and 6.47 respectively. The drop wasn't dramatic, but after weeks of painful volatility, even a small retreat is a welcome reprieve, especially for borrowers trying to time a rate lock. So what moved the rates this week? Well, if you're watching inflation data or Fed commentary for clues this week, you probably missed the real show. And it actually started overseas. Japanese bonds spiked early in the week, setting off alarms about global bond market volatility. But by Tuesday, Japanese yields sharply corrected and treasuries rallied modestly in response. The connection? Well, it's questionable. Historical charts show little correlation between Japan's bond market and ours. But hey, markets need a narrative, right? Well, back home, weaker than expected durable goods and corporate profit reports, plus concerning signals in the consumer confidence labor market data, help push bond yields lower. The 10-year Treasury dropped to 4.399 by Friday, its lowest closing level in 2 weeks. Mortgage-backed securities also responded in kind, and lenders followed suit with incremental improvements. The biggest takeaway, though, it wasn't a blowout week for rate relief, but we avoided new highs, and in my book, that's a win. Well, what about the PCE report? Yes, the PCE, one of the Fed's favorite inflation gauges, came in right on target. Core PCE just rose 0.1% month over month and 2.5% annually, exactly as forecasted. Actually, a little bit better. Sounds like a non-event, right? And yet, markets barely budged. And why? Because again, the narrative has shifted. Traders are more interested in what's coming next, specifically whether tariffs will sneak inflation back into the system this summer. So while Friday's inflation read didn't move the needle on its own, it reinforced the idea that we're in a holding pattern. The Fed's not ready to cut, and the market's not ready to celebrate yet.